Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now.
I think it's pretty clear that electric vehicles are the future of transportation, but that doesn't necessarily mean that investors should be putting all their money in electric vehicles. We have some history with this. Solar energy, wind energy, renewable energy in general is absolutely the future of energy, but that doesn't mean that solar stocks have done well at all over the last decade. In fact, they've underperformed the market by a wide margin in most cases. There was a lot of companies that even went bankrupt in the mid 2010s. So it's important to understand what the actual operating metrics look like for these companies. Are they able to generate cash flow? Are they able to reinvest in their businesses? And how long is the legacy business going to survive? Because I think it may be a lot longer than a lot of people think. That's what I want to dig into today. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you enjoy this video, check out my newsletter, Asymmetric Investing. Got a link to that in the show notes. And I want to start with this chart that shows cash from operations for 5 automakers. Now, this includes Tesla, Lucid, and Rivian on the electric vehicle side, General Motors and Ford on the legacy auto side. And I want you to look at the trends here. Rivian and Lucid are obviously in an investment mode, so they're trying to build out their capacity, but from operations, which is their ongoing business, that doesn't include capital spending. They're burning hundreds of millions of dollars per year. These are actually just the quarterly numbers, so you add them together, and we're actually talking about billions of dollars per year for both companies. And like I said, this is just for operations. Meanwhile, look at the trends for the legacy auto companies, particularly over the past year. GM is the blue line, Ford is the orange line, both of them increasing cash from operations over the past year. That's because demand for traditional vehicles remains really strong, particularly trucks and SUVs continue to be in very high demand. GM actually increased prices in the second quarter, and that's one of the reasons cash flow was so good. Prices were up and deliveries were up. The short supply that we saw during the pandemic because of a chip shortage is now behind us, and now we're kind of getting back to a normal level of supply and demand. And for traditional automakers, that means a ton of cash is coming in the door. Similar trends are happening at Ford. The core business is doing extremely well. These numbers would actually be even better if they weren't burning more than $1 billion per quarter in electric vehicles. Meanwhile, at Tesla, which is really the leader in electric vehicles, production is growing extremely quickly. The company continues to grow about 50% per year, the number of units that they're selling, but they're making less and less money on each vehicle that they sell. As a result, cash from operations is in decline, actually peaked last year and is now less than half of General Motors and lower than Ford as well. These are the trends that we want to keep an eye on. How much can you make a car for? How much can you sell it for? And then how much can you grow? The auto business lives in a world of supply and demand. This is not the traditional technology business where companies can grow to billions and billions of users. With automakers, you have to actually make a physical product. So we're going back to the metrics we should be using in the 1980s or 1990s to measure most companies. Return on invested capital, gross margins, how much supply is there in the market, how much demand is there for that supply. And this is where I think there's really starting to be some troubling trends that are really going to show themselves later this year and into 2024. The first canary in the coal mine was really Tesla. They started reducing prices for their vehicles late in 2022, and that has continued throughout the year. Then we found out in the third quarter, they're actually going to reduce production between the second and third quarter. Management called this plant upgrades, but this is often something companies in the industry do. They call for plant upgrades, but what they're really trying to do is control their inventory, control the amount of product that they're selling. Given the fact that price reductions and discounts, referral bonuses, free charging, these things have all increased in the third quarter, tells us that Tesla is making more vehicles than it can naturally sell in the market. The only remedy that it has if it wants to increase production is to lower prices. And prices are coming down faster than costs are coming down. As the industry leader and the only company that has really reached scale in electric vehicles, this tells us where the industry is going. Rivian and Lucid were the two other companies that I talked about here. And the one thing I have noticed in the last 6 months for both of them is they have stopped reporting how much backlog they have, how many pre-orders they have. As a result, they're increasing their production, but we don't know how much demand there is. Is that demand growing as production goes up, or is it going down? If we use Tesla again as an example, demand for the very expensive Model X and Model S has not been very strong, particularly over the past year. I think that's really bad news for Lucid, who's trying to be in that same price point, over $100,000 per vehicle. Rivian making a very different product with a truck and an SUV. But again, we have seen that Ford actually had to reduce the price of its F-150 Lightning, which is actually a bigger and potentially more compelling vehicle as a work truck than the Rivian R1T. That Rivian R1T starts at around $70,000. An F-150 Lightning you can now start to get into in the 40s range. So this is a really tough dynamic for a lot of these companies. And what we have seen in the actual numbers is that margins are staying really strong in the legacy auto business, and they're starting to really deteriorate in the new electric vehicle business. This is, like I said, this is the same thing that happened with renewable energy more than a decade ago. Despite the fact that these new energy sources were growing more quickly, it was actually the older legacy energy businesses that were making more profit. And at the end of the day, what's going to drive stock prices is, can you make money? Can you make a profit, especially in the manufacturing business? That's something I think investors need to keep more and more focus on. Right now, it looks like legacy auto is doing just fine, and the cash burn is going to continue in the EV business. But what do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.